What's going on, Hot Take Nation? Before we start this week's show, I want to introduce a company and a personal friend of mine, Steve Moore, who I've coached hockey with. Our kids play hockey. He's been a longtime friend, and he is with Magnum Cementing Services, which has been a top-tier well cementing specialist for over 13 years, as well as providing plug and abandonment services. And boy, have they pumped a lot of cement. They have 50,000 jobs under their belt from every company from startups to majors. They have hundreds of skilled employees across North America, and they are proud to serve the Bakken and the U.S. Rockies region. Of late, their lab team has come up with a chemistry-based solution for the challenging Braden Head cementing issues in the DJ and have been kicking butt in horizontal wells in Powder River. I recommend you check them out. They have pumping equipment that's almost nearly all brand new, state-of-the-art, assembled and manufactured in-house, and most importantly, since entering the U.S. market in mid-2019, they have 0 man-hours lost to safety incidences. You know how I feel about safety. As I mentioned, they are a specialist in cementing services. They've added a new product line called Magnum Infrastructure, which does cement soil stabilization work. If you haven't heard of soil stabilization, it involves taking a cement slurry, mixing it in the soil for the purpose of constructing a more robust pad, road, or other surface. You can use it with feedlots, construction sites, foundations for roads and highways, lease roads, and well pads. Brand new business, but they've already performed lots of awesome work, and I suggest you check them out. The way you can get in front of my friend Steve Moore, you can call him 310-701-3113, or you can check them out at magnumcement.com or magnuminfrastructure.com. Steve and Magnum, appreciate your sponsorship. Excited about this week's show. On with the show. What is going on, Hot Take Nation? It is JRW here for a repeat episode, but not repeat in the same way of like replaying it. It's because history repeats, and we have Dan Pickering for Pickering Energy Partners joining us again. The last time he was on was the week before Thanksgiving. And Dan, I don't know if you remember that. You were feeling bullish. The vaccine had come out, and we'd had a pretty good stretch of runs for the E&Ps. That has been extended, and for the last 3 months, you have been nothing but smiles, I imagine. How's it been going?
Well, David, thanks for having me back on. And the answer is it's been going pretty well. As George Costanza says, or Larry David, pretty well. It's fun when things come together. We had a little surprise Saudi Arabia production cut that certainly helped things. And, you know, this kind of push into the end of the year and Biden and scaling things back is helping the macros. So the answer is pretty good.
So it's interesting. So there's a couple of things I want to touch on. We're going to start with Saudi because you started there too. Now, to me, if you go back to March of 2020, which feels like both 10 years ago and yesterday, but the Saudis, instead of cutting at that time when demand looked like it was faltering and to punish the fall apart of OPEC, they increased their production for a period of time to 12 million barrels a day. Now, as I understand, they have somewhere between 500 and 600 million barrels of long-term storage around the world and another 90-ish million barrels of short-term storage. So clearly the world was not consuming the barrels and they were putting it into storage. So my takeaway from January when they made their announcement was they're cutting 1 million barrels of production, but they still had the ability to sell out of their inventory. And so net, it was more of a messaging than an actual. Do you agree with that take? And does it have ramifications for when that 1 million barrels a day comes back on?
So in the short run, whether it's messaging, signaling, reality, whatever it is, it moved the market and moved the market positively. So it worked. There's no question that general inventories are pretty high still. And I think OPEC's basically hoping to, vaccine comes through, demand picks up, and we soak this up. And so if you can bridge a gap you bridge a gap and make more money in the near term. Qualitatively, I'm worried about $57 crude. People talking about inflation and things like that again, with all this oil out there lurking. That million barrels from Saudi is coming back at some point, and every dollar you tack on the front month of crude makes it a little more scary when they issue that press release. So I think we really need the demand side to kick in for real, not just hope for it, but we need the physical demand. Otherwise, we're probably setting up for a correction here. And when it comes, it will feel, of course, it'll feel bad, as they always do. So we're enjoying it right now, and I'm kind of looking over my shoulder a little bit.
Now, how do you think about how the Saudis will message it? Because they have been very, very calculated, really. And we have round tripped. If you go back to a year ago at this time, and I'll use Centennial Development as an answer, because we're both on Twitter. You're more popular than I fully accept it. But last year at this time, I was talking about my position in CDEV, why I liked it in a $57 to $60 world on a relative view. Take the last year of balance sheet destruction and hedging out for all E&Ps. But the setup is almost the same price-wise, and yet the Twitter sphere is so bullish on these high beta names. It's interesting because one of the things you talked about in November was you weren't sure that the negativity around shale would pivot fast enough. And at least from the thermometer of the Twitter sphere, it seems like everyone not only bought in, but bought in big and bought in hard, and is seeing 2 and 3 and 4X's on equities that they've got into. What do you make of that shift so dramatically, as opposed to like a Chevron or an Exxon, which is kind of...
Yeah, well, I think what it says is that regardless of how people posture and position and what they say about their investment behavior around groups, and in this case, the energy group, there's a lot of people that said, I will never own energy again and I am staying away. But when things turn, do you run to the best companies or the worst companies? You run for the leverage, because if you're going to make a play, why not make a big play? And so you're right. Antero is a 10x off the bottom. CDEV is a 10x off the bottom. And if the dead patient lives, that's an infinite improvement from where you thought they were going to be. And that's kind of where these companies are at. And oil price, it is an oil price or a gas price for Antero's. It is a commodity price story, and the commodities, I think, clearly surprised everyone, even the bullish guys. So this is, I think, just another example of, folks say one thing, but when they vote to make as much money as they can.
So how does this, because I mean, I had a conversation with a hedge fund manager, and I assume he's listening to this and he will laugh because he'll recognize it. I said, I'm really struggling to understand this inventory thing that you talked about, because there is 8 million barrels a day that needs to come back, regardless of your view of Iranian sanctions and etc. But I'm like, how is that not more of an overhang, and how have people put on so much risk to drive oil well through 55 to 58, headed to 60, maybe it goes to 65? And his answer was, because until it's on, it's off. And if it's off, they're not gonna, the traders aren't worried about it. And so how do E&Ps right now manage that concern? So Callan's gone 33% in 6 days. How did they balance the fact that that's not a sustainable run for their balance sheet, even in this price deck? How do you hedge, trade, swap, buy, and how do you prevent losing investors when it goes to 52, for instance, and it undoes the last 50%?
Yeah, a couple of answers there. It's going to be really hard to protect yourself if you're one of those high beta stocks. You're essentially asking, how do you take the beta out of your story? And I just don't know how you do in the short run. I would also say that everybody that's more levered than they like to be is sitting and has a stock price that's done really well in the short term. They are asking themselves, can I get away with, how do I issue equity here? How do I take a potentially temporary run up in my equity and turn it into something that becomes more permanent by, protecting a damaged balance sheet. So it's a really hard discussion, because I think that equity offerings are going to get, they're going to get priced in the hole here still. I think trying to raise money is really hard. And, I'm on record as saying I don't want to buy any equity offerings, because all that does is give the industry more money, and we're trying to go the other way and get money out. So if you're a company, I think it's really hard. And what it says is if you could, this is the time to find some stock for stock deal and use that currency in a way that helps your balance sheet. And you're just gonna have to deal with the volatility that comes from being in a high beta stock.
Now, you talked about the equity offering, and so I did have a couple questions on that. In particular, do you think there's new appetite for incremental investment? Maybe not for you, you've said that you're not, but for the others who've raced back into the sector and have now seen it's the best performing sector in 2021? Or is this truly a trade based on the positioning, and just as easy as everyone came in, that if there's any, shake in the story, that people go away? Like, is equity raising from a broader market possible right now, in your opinion?
So NOG, Northern Oil and Gas, did an acquisition, had use of proceeds, and was able to get an equity offering done. So the answer is yes. You'd better have a story, and the question then is, can you get enough folks to accept that story? And the answer is usually yes. And it's the classic sort of individually. NOG's deal is not a big deal. It's when there's another one and another one, and sooner or later, the sentiment moves from something's happening in energy that's good to this is the same old story and it's blowing itself up again. And so you're running a fine line, and the challenge for the companies and capital raisers and whatnot is you never know that you've reached that point until is your deal going to be the one that tips people over or not? So I think it's still a very challenging capital market.
The follow on I was going to ask was about NOG, and Enerplus I think falls in that category too, where they both did cash deals, with different circumstances, and that was the catalyst to be able to raise equity. Now, if we look at the macro, so we'll move away from the high beta names, and yep. I think if I summarize correctly, it's they have to do something. It probably isn't a capital raise, just because the appetite probably isn't there. But this is a pretty good time to do some pairing up, dance partner, equity for equity. So we're going to see something happen amongst these high beta names sooner than later. Now, in the last 2 weeks, we saw Chevron and Exxon in particular. I'd add Conoco to that, but they both came out with their earnings, which were not great. Now, we had a horrible 2020. I'm curious how you think that the ESG setup and some of the activists, the little engine that could in Exxon, how does this all set up for the majors? And what do they do now with the Biden administration, with the executive order on the federal lands, on potential greenhouse gas emissions, Larry Fink's letter talking about the net carbon zero 2050, where do these super majors go, in your opinion? And what did you learn from their quarterly reports that were interesting to you?
Yeah. So the super majors, I think, actually, as it relates to, so I put ESG in one bucket and energy transition or peak demand in another bucket, but I think you can't ignore ESG, and Chevron, I think, has the best tagline ever right now, which is lower carbon, higher returns, or higher returns, lower carbon. I mean, so simple, you get exactly what they're trying to do. They've also got, these big super majors have enough money. They got enough cash flows. They've got a big enough business that they can allocate a reasonable chunk of absolute dollars to energy transition initiatives, carbon capture, wind, whatever it is. And not dramatically change the business. Now, BP has said we want to dramatically change the business. So I think the majors can sort of baby step their way toward whatever the future looks like. They don't have to make a big enough, 1 year or the next year kind of investment that it's meaningfully or radically changes their business. I think it gets a lot harder when you get down into smaller companies. So if you're 50 billion and below market cap, your profitability is squeezed, you're staring at the same weird future that everyone else is. And what are you going to do? Are you going to take cash flow you don't have to try and baby step your way as well into these things? Are you going to ignore it? Well, you can't really ignore it because then you look out of touch and the market loves everybody that's not ignoring it. So I think the smaller you get, there's a weird middle here where if you're really small, you don't have to care. I'm just doing my thing. If you're really big, you can baby step your way. And if you're in the middle, you got some serious strategic questions to answer. But your question though was super majors. I think that they're going to deal with this issue on a ongoing basis. In the meantime, they're doing what everybody else is doing, trying to delever the balance sheet, trying to, maybe find something to do. Exxon, Chevron, supposedly rumored to get together. That, won't go anywhere. I do think the one thing they're all going to consistently do is that you mentioned greenhouse gases, the quote unquote easy stuff around ESG, everybody's going to go hard at that. I mean, flaring and emissions are just, it's visible. You can find it with a drone, you can find it with infrared, et cetera. You're going to have to fix that. And if you don't, you're shame on you, because the world wants it and it's not that expensive. You're going to have to do that stuff. So that's going to be the one consistent thing is flaring and emissions are coming down. Guys are going to do the low hanging fruit from an ESG perspective.
Now, we talked about this in our last discussion around valuation versus price. And so clearly with what Biden has done, I think it was interesting. You'll remember when he came out with the executive order on the 20th, most of the big federal guys like EOG is one, Concho, even though it had traded, but these guys were trading down 8 and 10%, which they've not only undone, but they've grown. It's amazing that the market seems to have forgotten that. It seems like it's going to get harder from regulations. It seems like it's going to get more expensive. And even if you overlay a higher price against a weaker return profile, and then add, as you talked about, BP is trying to get into wind and solar, which may not be even the returns we see in oil and gas in steady states. So we're driving returns in an already poor capital return industry lower. How are guys going to balance this Larry Fink saying, everything is sustainable, but to spend those dollars, like on an electric frac fleet, it's $60 million versus $24 million. And they don't have the pricing power to charge more for that. So the service company is just going to take a hit into their profitability. How do those two things coexist? And as an investor, how are you looking at that?
Yeah. Couple points. You're right. The more regulation and less access, there's a real hit to value if you thought you'd be able to drill these acres and you can't. The flip side is that's tightening the market. And are you making it up in a stock market sense? Do you make it up in multiple what you're losing in future cash flows, and that's been the case so far? I think there'll be volatility around that. How do you invest or deal with things like $60 million electric frac fleet? The answer is you don't spend very much money on it, but you spend some if you can. So Halliburton can do that on the fringes, but there's only so much low return on capital investment that you can do, and the smaller you get, the less you can do of it. And And so if you're the small guy, what are you waiting for? You're waiting for the market to get better. And then maybe one of your customers is going to pay for you to do it. If you're Halliburton, you can dip your toe in the water, but sooner or later you're expecting margin to make that up. And if you're an E&P guy, you're saying, I better do some of this stuff because the alternative being getting cut off from the capital markets because you're not a good ESG player, or getting some sort of regulation that comes in broadly and restricts your business. I mean, those things are pretty onerous. So it's going to be a qualitative approach to a quantitative problem. And the amount of money, folks are going to just have to figure out. They're going to have to shake the piggy bank. And if there are a few coins in there, that's your low return stuff, I think.
What's been the biggest thing that surprised you since the last time we talked around Thanksgiving? And exclude the Saudi surprise, because I think that's fair to say that was a massive surprise. But what other things have overlaid in the backdrop of the energy complex that have been surprising to you, that you're now, it's taking a much more of your mind share to think through?
It's a good one. So now we're sort of, I would have said commodity price generally, right? I'm on the record saying we don't get sustainable $50 crude until the end of 21, early 22. And now we've got the price in January. So price is much better than I would have expected. And I don't think it's all Saudi, but price would have been the one thing. And so now what do I have to do? I got to figure out this run. To me, the hardest part right now is I think there's a meaningful move higher over the next 2 or 3 years. And the question is, how much of it did we just get in the last 3 months? And are people going to just keep looking through, and therefore we don't ever get a big pullback? Is there something I want to trade around the margin? How much can we look forward? And so, David, I thought the good tells here, and I've talked about this a little bit in my monthly letter, and was just Schlumberger, Halliburton, and Baker Hughes all beat earnings, and the stocks really didn't go up much, which tells you there's a fair bit of expectation baked in. The flip side is you had weak numbers from NOV. After an 80% move, the stock didn't go down that much. And so there are dip buyers out there. There are guys that are kind of wanting to hold on. And so I'm sort of in the mood saying, I know I want to be there for the next 3 years. What do I want to do for the next 3 weeks or 3 months? And I'm kind of letting the market tell me, which I don't know if that makes me an analyst, a portfolio manager, or a Reddit trader, but I think
probably a little of both.
You got to take your cues from the market here. So that's what I'm spending most of my time figuring out, is how big's the pullback going to be, and is it tradable or not? I think the investable move is much higher, and if you want to be cute, when's the time?
Right. It's a great construct, because as you look at the next 3 years, and I would say, one of the learnings, and I've gone on record, so no one knows that this is a surprise. So I owned my CDEV. I was way up. I held it, got crushed. The run up in June felt fake. Sold it, went short, missed the timing, and now not positioned at all. Everything is a timing thing. So how does one buy something that they like, have a 3-year window where, as long as the normal thing happens, which oil's 57, which if we'd been talking a year ago today and you said oil's going to be 57 for the next 4 years, I would have been like, perfect, lock the stocks in a bin and go away. But we've seen such dramatic swings, and now this overlay of Europe wants less energy. They want more energy, but less fossil fuels, and BP and Shell and transition and the New York pension fund divesting stocks. And there's so much noise. How are you as an investor able to cut through all that and decide like what's tradable and what's not?
Yeah. So let me do the investment piece of that first.
Okay.
Which is, oil really isn't 57. Oil's, I mean, that's the front month. The 21 strip is like 51, some 50, 51. The 22, 23, 24, 25 strip, all those are, 46 to 50 right now. So we're kind of still sub 50 if you really looked out over time. I think that's too cheap. I think that will be higher. That helps form the base. I mean, your investing decisions are, do you think the commodity is fairly priced? Is the industry acting rationally? What's supply and demand going to look like? Demand's going up, supply's coming down, industries being pretty disciplined about cash and cash deployment and reinvestment, which helps me on the supply side. And you just roll all those things together, and barring more COVID or barring those things, then the market's tightening up. So that means my investment thesis with the stocks valued where they are is constructive. I think, how do you cut through noise? So less fossil fuels and divestment that you mentioned, to me, that is a little bit noise, because those things are going to play out over 25 years, not 25 weeks. And everybody that's staying away, those are the people that were staying away last year when CDEV was 50 cents.
Yeah.
And when Devon was, single digit stock.
Yeah, $6. I mean, Devon's moved more than 300%.
Exactly. Halliburton was 5, right? I mean, so I'm never going to own them again. That sort of stuff, that is noise. And we talked on our last podcast, I said people will be back if the performance is there, and the performance will be there if the commodity improves. So to me, that's the noise you cut through to pick your, whatever your core names are, and you own them. And then you're thinking, do I trade around them? And you're looking at to me, the technicals are, and the kind of what the stocks are telling you are better indicators than almost anything else in the short run. And if I know I'm going to own this core position for the next 2 or 3 years, I don't have to sweat too much. I don't worry that much about what the quarterly results are. I listen. The scary part, the scary one, is what happens if something changes with the companies you own. Yeah. So Devon, I've mentioned it several times. It's a own stock for me. If the CEO, Rick Muncrief and Clay Gaspard and those guys come out and say, we're adding 10 rigs, we're going for it. Well, all of a sudden that is a meaningful change. And so then you don't worry about trading it. It's like, okay, I don't want to own it anymore. So the company specific stuff says, does it go in that core bucket? And then the trading dynamic says, do I want to trade it? And you try to weed out everything in between.
So you talked about the market giving you signals, and the best example I can think of, again, hindsight's always 2020, and in particular it is 2020, but oil was trading at 50. It had moved from 63 to 50 in the fear of coronavirus, when the stock market itself, the S&P that uses the oil, had still traded up. And so all of a sudden everything caught up, and oil was the canary in the coal mine. So on the one hand, you could say oil prices running up are the canary in the coal mine. On the other hand, you mentioned inflation, and everything I've seen on the spreads now between the 30-year and the 5-year, and the way the market is looking at inflation, food inflation, monetary inflation, like it is the only thing that trips this market up rates. And is the market telling us that rates have to go higher, and we're still ignoring it, given the huge moves we have seen and continue to see in the broad market?
Inflation is the logical outcome of everything that's been happening for a while. Huge monetary stimulus, all this money pouring into the economy, everything that's going on should drive inflation. Now, it's been happening for a while, and inflation hadn't showed up. And so, this 10 years of no inflation kind of gets people saying it's never going to happen. And it's kind of hard for rates to go up too much because everybody's borrowed so much money. They go, broke if rates go up too much. So inflation ought to show up. Technology probably can't keep it down at some point. That will be great for our sector and eventually really bad for this market. And so lo and behold, more cycles. So I don't think we can get away from our business being cyclical. I think the peak demand stuff and the energy transition overhangs and all that probably lower valuations cycle to cycle. But for all this to happen, oil and inflation is not going to happen with oil at 57. It's going to be higher than that. And if people believe that trade at some point, they'll take it, right? These trades get a mind of their own. That's been sort of the hardest part for me, David, is some of these things that ought to take place over the course of 2 years don't take place at all. Some of the things that ought to take place over the course of 5 years happen in 5 months. And which is why you got to pay real close attention to how people are trading these things.
So we talked about natural gas, and an example of a name that you brought up was Antero. And I use them, they're high debt, great assets, great fundamental value, midstream complexity, a lot of firm transport. And as you said, they've come up 10 times. NGLs are ripping. How do you think about the oil game versus the gas game? And do you favor one versus the other at this point? And how do you balance out an issue like Antero to grow into its firm transport will take a lot of growth and continued growth, which is a different issue than perhaps an EQT or a different issue than an EOG. How do you think about that natural gas versus oil split and what you're feeling better about right now?
Yeah, I still like oil better than gas, and that's because from an inventory perspective here in the U.S., I think we still have a lot of relatively low cost, relatively high deliverability inventory. There's still we're dwindling down. We're cutting through core Marcellus and Utica inventory, but there's still plenty there. There's still, a lot of Haynesville inventory. And so I just believe the ability of the market to add a few rigs, the ability of the industry to add a few rigs and influence the market is higher in gas than it is in oil. And oil's this global commodity. It's harder to figure out. It gets more play as a trading commodity, et cetera. And so I just think there are probably more ways to win. And, it's going to take a concerted effort by a lot of companies to turn the U.S. production decline in oil. It doesn't take nearly as many companies to make that turn happen in natural gas. So I just think the ability to get smacked by supply is higher in gas. And then when you think about the gas companies, it's an inventory question and cost to supply question. And the trick there is a number of these gas companies they're making okay returns at $2.50. Not great returns, and their balance sheets aren't where they should be, and that's the bigger problem. But the core business, the unit economics are okay at $2.50. So, I don't know how we count on meaningfully higher prices than that on other than a cold weather trading type basis.
Right. Where are you at in hedging right now? And we're going into Q4. The super majors have come out and they're not notorious for their hedging. We have smaller guys. We have cases where three-way swaps and collars and fancy derivative products, like in Oxy's case, they ended up blowing through the floor and it didn't really protect them. We now have a second bull market, a second chance at it. Do you think we're going to see a lot more hedging? And as an investor, are you excited to see them take some risk off the table on the commodity side? Or do you think that you wouldn't be doing that?
Depends on the company, but here's what's interesting to me about hedging. hedging protects cash flows. It's never protected stocks. The decently hedged companies and poorly hedged companies go down almost the same amount in a bear market when the commodity tanks, because nobody ever hedges far enough out. And when that curve collapses, it's like, oh, great, you got 2 years of hedges and then you're dead. And frankly, we're seeing some of that now. Prices tanked a while back, and companies were going bankrupt in 2020 because their 2-year hedges rolled off. So what's interesting to me about hedges now is it can protect cash flows in the balance sheet, and you're probably still going to get paid on the upside in the stocks. And so I think any company with a weak balance sheet should be thinking about doing some hedges here, because what you're doing is you're eliminating the likelihood of going broke. And that's still pretty important for an overlevered company. The market's still nervous enough about the sector that if you don't have that protection and Saudi brings back $1 million and crude goes down, you don't want that to take your company under. You don't want to be the guy who blew it twice. So I do think we'll see a lot more hedging, because you fight the battles of the last war, and some of those hedges will be bad. Prices will go up more, but it doesn't mean they're wrong, because we have ultimate liquidity. We investors, great. I get mad, I'm out. I'd sell my whole position tomorrow. These companies gotta be in business. So I think they'll hedge. I don't mind it here. And for some folks who are quote unquote reducing beta, that may impact investors on the margin, and that's okay. That's probably not the long-term investor you want in your company.
Yeah. So last question for you. I'm going to talk about midstream, and in particular DAPL, because the Dakota Access Pipeline, I believe that they're now at the point where their right-of-way has been withdrawn, their temporary right-of-way. They have to submit some information to continue to flow. Now, backstory, I think everyone knows, DAPL has been flowing, has continued to flow in spite of some of the regulatory and legal challenges. But we're now at a place where, on the one hand, investors thought, well, maybe Biden is throwing away Keystone, which is still years away, in order to save DAPL. And on the other side, we've really seen most of the people taking cabinet positions and important positions in the Biden administration, their number one criteria has been that they've been a climate and environmental activist. So what do you think happens to DAPL, and how does that change the dynamic for some of the companies in your universe that you're watching?
This is my weakest area, David. It feels like something that's up and running kind of stays up and running, notwithstanding attacks here and there on it. We have consistently seen, if you trap hydrocarbons somewhere, pricing is going to stink and basis blows out. And so I think the uncertainty issue is the hard part. When you think about how capital is going to flow, it's going to be much harder to put money to work if you're concerned about pipeline access, for instance. And so companies that have the ability to shift capital from one spot to another, Colorado is not going to give as much capital as West Texas. And the industry generally is not going to get as much capital when you're unsure about federal lands and new regulations and whatnot. So, I think the future we're in for the next 4 years is that, there's a lot of focus in the administration on energy. It's just going to be green energy, and, conventional energy is going to bear the brunt of it. I think there's a practicality, David, to what the regulatory side can really do, because if you squeeze too hard, gasoline goes up and home heating costs go up, and that isn't good either. So you can only push this industry so hard in the short term. So I think new stuff, very, very hard to do. New infrastructure, new permits, new leases, that's going to be very hard to do. Status quo stuff, probably okay, slightly more expensive. And ironically, again, unintended consequences, all of this stuff makes the likelihood that commodity prices rise go up, and it makes everything that's in the ground today on the margin gets more valuable because it's going to get harder to add to it. So you want to quote unquote hurt the energy business. Well, you're actually driving more cash flows toward it and making the things that they own more valuable.
So constructive and continuing to be constructive with some caution around a depth of pullback, just given how hard and how fast we've moved. Fair to say?
Yep, I think there's a lot more money to be made here still. You don't have a 6-year downturn and a 6-week upturn, and this business is cyclical. There is more to come here, and expect volatility. And so the real question is not going to be, are we going to have a pullback? It's what do you do during it?
Love it. Well, Dan Pickering, as always, I appreciate your insights, and I think that especially in the context of how much has changed, the awareness of the risks and the way that you're thinking through it, I think help the employees that you said when we last spoke, that there's probably some guys that may not have a career, but this is probably an additional lease for some that will kick the can down the road as activity picks up to meet the current demand for crude and natural gas.
Agree. And I have to finish with my 2021 tagline, which is mega, make energy great again. So I'm staying positive despite the chaos in the world.
I love it. It's a great place to be and a great place to be positive. So Dan Pickering, thank you so much for joining us.
Thanks a lot. Appreciate it, David.
Until next time, be safe, be good, have a great day, and bye for now.